Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Good morning, everyone. This is DJ speaking. Today is the 9th of November, and you're listening to the Weekly FX Navigator. Now, we can all agree that while central banks are shifting away from ultra-easy monetary policies, they have not really validated the recent shift higher across their money market curves. So in light of that, today's episode will span a broad review of what central banks did last week, and that includes the RBA, the Federal Reserve, and the Bank of England. So first up, the RBA. We've covered that decision previously, so we will just focus on the statement of monetary policy. So the clear message here is that inflation will take some time to sustainably rise to the middle of the 2 to 3% target range. Now we feel it's mostly about wages, where wage projections have hardly moved at all, and labour productivity also needs to remain unchanged for wages to spill over into core inflation. The central bank is guiding to hikes in 2023 in the case of sub 4% unemployment and above target core inflation. We feel hikes could come a little later than what the market expects, and while terms of trade remain supportive for the Australian dollar, we think the currency could chop around in the near term. So for the Australian dollar, we see key resistance at around 75.60. Now moving on to the Fed, we felt that tapering was already largely priced in. On a whole, the Fed meeting was largely balanced, but Fed Chair Powell went to great lengths to push back against market expectations of hikes. Now, going into the meeting, we as a team were largely neutral on the dollar, and now that that meeting's done and dusted, the attention will be on US CPI data tomorrow. Although dollar positioning is a lot cleaner, leveraged funds are still net long. Lastly, on technicals, a sustained break above 94.65 to 95 for the DXY index is a key risk to monitor. And we're finishing up the podcast with the Bank of England. If you've been listening to a podcast, you know that we've been holding a bearish bias towards the pound ahead of the Bank of England decision last week. Now, we felt that market implied rate expectations were a tad too optimistic considering the headwinds the UK economy faces. Now, the pound tumbled as the Bank of England kept rates on hold at 10 basis points, in contrast to the market's expectation of a 15 basis point rate hike. Now, the moves have panned out as expected given our bearish pound bias, which we expressed via a bullish euro pound idea as well as a bearish pound dollar idea recently. So the focus, in our view, will likely shift back towards Brexit-related headlines. So for now, global liquidity remains ample, risk sentiment should stay supported in the coming weeks. And that marks the end of the podcast. As usual, we're keeping things short and sweet and straight to the point. If you're a valued client of Standard Chartered, grab hold of a relationship manager to find out more about our publications. If you've enjoyed what you've heard, remember to like, share, and subscribe. We'll see you in the next episode. Bye-bye.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.